section. So welcome everybody to the last PAG meeting of 2022. It comes at an auspicious time after the launch of the exposure draft, and we're already starting to look in this group at the next exposure draft and what's going to be coming out there. But Sam, before we got started, do you wanted to get a flavour of the reaction to the exposure draft launch, just from you?
I can, yes, just briefly. Have I think 37 people who've so far submitted that they are planning to share a response with us, and that's growing. Lots of positive energy, excitement, hearing keenness to get stuck into the material and share views. We had a meeting a couple of days ago. I was invited as a panelist to a meeting of a few hundred people in Bangladesh, which they hosted and just invited me to come. And there's other events like that. So it's quite exciting. People are really keen to dig in. I know in Ethiopia as well, there's a lot of energy and anticipation, and people are enjoying reading it so far. So far, so good.
And Karen, did you get any feedback on the impact of launching at the World Congress of Accountants? And have you heard any more?
No, only a very, very high level from Ian, who was there. I think that they seemed to have a fairly positive response from those in the audience there. So I think as far as we're concerned, a really kind of positive start with this. We know that we've got a lot more to do in terms of outreach and so on. But yeah, no, I think very much welcomed and kind of resonated with the audience. So positive.
Great. Well, yeah, I think it was pretty exciting and quite a coup to get it launched at that event. So well done, Ian and Asietu, who's one of our steering group members who led that. So we're going to change the agenda very slightly, which I haven't warned Sam about. We're going to put the outreach last, just because really don't want to make sure that we definitely have enough time to discuss some of the things that have continued to be very, very thorny non-profit accounting issues around grant expenses and revenue. So we're going to start with the grant expenses paper, then do revenue, and then come back to the ED outreach. And if we run out of time, we'll maybe solicit feedback on the ED outreach by email. So welcome, Pesh.
Hi.
And we're just going to start, and I'm going to hand over to Philip to contextualize the grant expenses paper and take us through it.
Me unmute. Can everyone hear me? Perfect. Lovely. Yeah, thank you very much. So yeah, so this paper is focused on grant expenses. I mean, it's useful to reiterate that that's the accounting for the expense by an NPO that is providing a grant to another entity. We're not directly concerned here with accounting by an NPO of a grant that it has received. That's going to be covered as part of the revenue papers. So based on the consultation responses, the TAG agreed to the development of guidance based on the principles contained in the draft IPSAS on transfer expenses. So these proposals have been developed on that basis. And this paper highlights the overall concepts and terminology for grant expenses. I appreciate, having gone through this on first read, this is a little tricky and can be quite difficult to get your head around. So I think we're going to try and provide a high-level overview now, if our technology works, and we can run through a flow chart to try and better contextualize what we're talking about. Perfect. So we basically start at the top with two essential questions. The first is whether there is a written, oral, or similar agreement that confers rights and obligations on the grant providing NPO and the grant recipient. And the second essential question is the agreement enforceable through legal or equivalent means? Now, if either of the answers to these questions are no, then the binding grant arrangement that we defined does not exist. And in this case, the grant providing NPO is usually going to recognize grant expenses effectively when it transfers resources to the grant recipient. So that's the simple, easy version. Basically, if the NPO transfers some cash to a grant recipient, it will recognize the grant expense at that point at the value of the cash transferred. Now, if a binding grant arrangement does exist, that's when it gets a little trickier in terms of just the number of terms that we've had to define and how the NPO needs to work through it. So the first thing the grant providing NPO needs to do if a binding grant arrangement does exist is it needs to effectively examine the individual rights that it has to have the grant recipient do something for it in exchange for the resources it's going to transfer. So in our terminology, that is the grant providing NPO identifying each distinct grant satisfaction right it has to have the grant recipient satisfy a compliance obligation. Now, for each distinct right, the grant providing NPO also needs to work out actually what's it going to cost me to have this right to be fulfilled, which is the grant payment consideration that it needs to pay to the grant recipient for that right to be what we've defined as extinguished, which is a bit of a legal term, but basically that's the right being fulfilled and the grant recipient doing what it said it would do. Once that grant satisfaction right has been extinguished, that means the grant providing NPO at that point has to recognize the grant expense because the grant recipient has done what it said it would do. So the expense is now on the grant providing NPO. There is then a slightly tricky timing ip because either the grant providing NPO might not have transferred resources yet, which means it needs to recognize a liability because the grant recipient's done what it said it would do and it has the rights to the resources. So the grant providing NPO will need to transfer that. Or occasionally the grant providing NPO might actually give the resources in advance of the grant recipient doing what it said it would do. In that case, we've defined something called a grant prepayment asset. So if I, as the grant providing NPO, give the grant recipient, say, $100, and the grant recipient actually hasn't done anything yet, I would de-recognize my $100 from my cash, but I would also then recognize a grant prepayment asset of the same value. And once the grant recipient has done what it said it would do, I will de-recognize that asset and recognize the expense. So it's a very sort of high level run through of the overall sort of conceptual framework that we've developed, which is based on the IPSAS framework for transfer expenses, just made a little more simplified and hopefully easier to understand. Now, the first actual question we had for the PAG was around terminology, but I'm wondering if anyone just has any immediate thoughts on that overall conceptual framework and the understandability of it.
Great. So that's Pesh coming. So the question is about the overall thoughts.
Yeah, where does the concept of a constructive obligation come into this flow chart?
So if you see the binding arrangement does not exist.
Yes.
So if there is a possibility that the NPO that's providing the grant may have an obligation to transfer resources under that, so it may have a constructive obligation there. I left that out here just to be a bit simpler. If the binding grant arrangement doesn't exist, but there is a constructive obligation, at that point, we'd expect the grant providing NPO to recognize a provision in.
So right on the top where they talk about, is there written, oral or similar agreement? I think that's where you want to bring in saying that if there's a constructive obligation, then it's treated as a binding grant agreement, because it's not binding because it's not legally enforceable, but recognizing that for accounting purposes, you would have the need to recognize an expense even though there's no legal obligation.
Yeah, so at that point, but that because we've got this dual framework where we are very focused on whether the binding arrangements exist. I appreciate there's constructive obligations on both sides effectively. It's just the methodology used by Ipsas is that it's this binding arrangement and the rights and obligations that exist within it that sort of drive the subsequent accounting.
But I've got a concern that the flowchart as I see it will mean that if I have a binding obligation, if I have a constructive obligation, I don't have to account for liability. So it doesn't recognize that a constructive obligation can create a liability.
Karen, did you want to come in?
Yeah.
And just
I can come in. I think we've just done a simple flow chart here just to aid the discussion in the meeting today. So the full text will describe all of that. A constructive obligation can lead to a binding arrangement, and I think it's the flow chart that's important here in terms of what sits behind it. So is there a written oral or similar agreement? A lot of constructive obligations are done through some kind of oral agreement. In the public sector, we see it a lot where a minister stands up and announces that they're going to do something. And then the question is the agreement enforceable through legal or equivalent means? Now, a lot of constructive obligations obviously don't have legal, but if the constructive obligation is such that the entity has got no means to avoid it, then we would say that that is a binding grant arrangement, and this will all get explained more fully in the guidance. But we haven't put everything in this flow chart just to make it. We can put it on one page and make it manageable, but yeah, that is the intention around constructive obligations.
I think that's fine, as long as we make that clear, because I think a constructive obligation is not enforceable, but you would still account for it as a liability, and that's what we've got in sort of FRS 102. The concept, and also in the charity SOAP, because otherwise my concern is that what we were seeing happening is most organizations were putting some clause in which said, well, if we don't have the funds, we don't have to pay, and so therefore that they had a legal get out, but we didn't still want them to actually account for it, because they wouldn't. The argument was they would not realistically withdraw, and although they could in theory withdraw, and in practice they could withdraw, but realistically they wouldn't withdraw, and that's the whole constructive obligation argument, which I feel is missing in here, unless, as you say, Karen, if you clarify that, then I'm comfortable with it.
So yeah, so that is driven by the need to get this on one simple slide. We've got there is in the main one whether the MPO can realistically avoid the transfer of resources, and the sort of the application guidance we're developing around that does cover those sort of situations.
Okay, fine.
Great. So thanks. That's a good discussion and points well made, Pesh. I think Verena had a hand up and then Nigel. I'm not, but if we go in that order.
Thank you, Tim. I just had a little question on it seems that it's like a snake when you have a mismatch between the cash flow, that means that you receive prepayment for the grant, and then it goes into grant expense recognition. I would think that it would be a rather unusual situation that the grant providing NPO will measure the cash flow payments based on these satisfaction rights. They usually have some sort of payment plan, but rarely in practice we see that this is matched. So I think perhaps, I don't know how you're going to change it, but I expect a lot of questions on that. And also, how do you distinguish, how do you measure these satisfaction rights?
We'll take Nigel's points as well, I think, before comments on those.
Thanks, Tim. All I was going to add to the debate so far is part of my problem is this binding agreement phrase, because it implies legal And that links onto the constructive obligation discussion that Pesh initiated. I think you'd be much better off with a word like formal or written, or something which is more clear to explain and understand. I think when you're this idea of binding, well, in effect, if it's not contractual under law and I can't be sued for it, then it isn't binding. It is ultimately discretionary. And that is the difference, fundamental difference between not-for-profit and for-profit accounting. And I think I have a suspicion a bit of commercial mindsets come into this, particularly when we get to the revenue paper later on. Thanks.
Great. And then, yes, if you bring Karen's comments on that relate to the conversation we're having here.
Sure. So her comment related to the terminology around grant expenses, and Philip, in your introduction, you clarified what you meant, and I also have to do that every single time I talk about this topic, have to clarify its meaning. So she didn't suggest an alternative. My suggestion would be grants payable. That's how I normally describe it. And because so much of this grant expenses accounting is linked to when you recognize a liability, grants payable immediately puts somebody in the sense of, oh, this is making grants and reduce. And comment is whether we have to use the word extinct, but I'll end there.
Thanks, Sam. I hope you caught all of that. But if not, please just ask. Any reaction to those three sets of comments?
Yeah, so on the, sorry, it is jumping a little, but on the sort of the cash flow point and the grant satisfaction right and measuring it, I have seen where entities have sort of prepaid grants and then will only recognize the expense at a often quite a considerably later date. So I mean, I have witnessed that in an MPO and a UK charity setting, and in a sort of, especially in Europe and the European Commission and an aid setting. So I think actually that sort of prepayment and recognizing an asset might be more common than we anticipate. The distinct grant satisfaction right and working out what that grant payment consideration is, I think will depend on the nature of the grant. It might be quite simple. If I'm giving a specific amount of money to an entity to, say, spend on the school fees of a group of children, I will know specifically how much those school fees are going to cost, how much that entity will be due if it is going to pay those school fees. And then if I give that money in advance, I can recognize that asset and then recognize the expense when it's actually paid them over and those children have gone to school. So hopefully, if we provide the implementation guidance around transfer expenses runs to like 80 or 90 examples, I think. Ours are hopefully going to be less, but I think we are going to have, and this is why this group will be very important, very good specific examples that really can bring alive situations where this does occur, so it can be understandable to MPOs. On the binding arrangement, if it isn't legally enforceable, and if that's in a certain sector isn't very common, then hopefully the expenses recognition will be quite simple, because it will be the non-binding arrangement route, and it will either be when the money or other resources goes out the door, or they will check to see if there is an obligation, and if that obligation exists, then hopefully the recognition of a provision and an expense. So I'm hoping that for those jurisdictions where, say, there aren't often legally binding grant agreements, then it will be quite simple accounting. And then on the grants expenses, grants payable, extinguish point, I think this is the question we're coming to, with terminology that works and doesn't take people the wrong way or make people think this isn't relevant for them. So if there are other phrases that would resonate better, then we'd be very welcome for them to be be put forward.
Great, thanks. Karen, do you want to come in?
I was reflecting on Nigel's comments about binding arrangement and how that is perceived. I mean, interestingly enough, this is a term that has been generated through the work that IBSASB has been doing. So it's very much a public sector term that's been created, that's not been influenced by commercial practice at all. It's been influenced by the various different types of agreements that government bodies can have with other levels of government, particularly as well as outside. And how do you create a term that is not a contract, but does have some kind of enforceability, and we're really clear here that it's about legal or equivalent means, and I know we don't define that here, but it is beyond a formal contract, but it is an arrangement to which both parties have obligations. And so IBSASB has landed on the term binding arrangement to describe those relationships where there are obligations on both parties to do something. But it isn't intended to be entirely legalistic. So it's your reflections are quite interesting, and we will reflect on it. But you came up with two alternatives, and I think like written agreement, well, we want to be broader than a written agreement, so that won't work. Formal agreement sounds just as the same as a contract. So I think we'll have a think about it, and if anyone has got any suggestions around that, or thoughts about further thoughts about how that might be received, they would be really, really welcome.
Ash.
So the way I was looking at this is we agonized about this quite a lot, both at CAPE when I was in the Accounting Standards Committee, and also on SORP. The idea that if an organization just simply says we're going to make $100,000 worth of grants next year, and even commits to saying that we will spend this money. So like government saying we will decide to spend this money on, I don't know, let's say climate change or something of that kind, or sustainable energy. That to me doesn't create an accounting liability. It needs to be much more specific. You need to have identified a recipient. You need to explain something. So you've created that. It's almost a state of mind issue. Have you created the state of mind in that a particular recipient that they're going to get some money, and on the basis of that they've chosen to do something, maybe commit further grants or employ people or something of that kind? That leads the concept of constructive obligation as I know it. And it's not just if there's an oral statement made, what is the nature of the statement? Whether even if it's a written statement or an oral statement is not what I'm worried about. It's what is the nature of the statement? Does it do more than just saying, well, we're going to spend £100,000 next year, or we're going to pay money into this program or project, without actually identifying who they're paying it to, or something of that kind.
Okay, thanks, Ash. Umu, got your hand up.
Okay, thank you. Yes, in fact, okay, this is very interesting about all these binding arrangements and obligations. And what I see, responding to question one, the definition of grant expense, it doesn't show the obligation side of it. It just says arising from a transaction, and further on by transferring cash. We don't see the term obligation in that definition. So that's one of my concerns there. And also when it comes now to, I mean, where there is a binding arrangement, obligation, whatever, to provide funds in multi-years, I think the question was raised also, like how to ensure that the cash provision is there for grant expense that's not yet disbursed. It's shown as expense, but not disbursed yet. How can we ensure that this will be, shown somewhere in the statements or cash flow statement, wherever, to ensure that the provision is there, is still there. Thank you.
Thanks, Umu. And I'm going to step out my chair role for a second as well. I don't know where it might fit, but there feels like there's some space to say why this is all important somewhere in this, because for me it's quite a lot about the accountability of the grantor here. So in the government's case, yeah, really fulfilling, not just being able to make, as Pesh kind of put it, vague proclamations about spending, actually creating proper obligations, and for those to be enforceable is pretty important. And it's the same with the philanthropic sector, that often have, many of, it depends again on the nation to nation, but many nations have a requirement that they spend a certain amount of their endowment to comply with the tax obligations. And again, if it's kind of hand waving only and not really enforceable obligations, these things are important. So I think that some context, and then the other context is the sort of the mirroring of these arrangements, because I certainly see that. I'm sure that I'll be interested if other PAG members, that in quite a lot of cases there, the current status quo is it's not all being mirrored. Foundations are actually recognizing these things on a number of different bases, quite often just when they're being approved as expenditure, and yet the grantees are, and that means that the whole system is not very coherent right now. So, Philip, do you want to take us in?
Yeah, well,
should I do that round, I think, and we take us in a bit deeper.
Yeah, so if I just come back quickly on, I'm trying to think, I think it might have been Pesh's point, what is the nature of the statement and thing. I think that's why we've got at the top, it really is the rights and obligations on both the provider and the recipient. So if rights and obligations have been generated, then that's when we're in this world of looking to see if it's enforceable through legal equivalent means or not. If it's just a vague statement saying, I'm an MPO and I'm going to spend $1 million next year, but you don't identify who, there aren't any actual obligations on an individual recipient to do anything with that money yet, then that is a different world. The multi-year grants we will come back to, because I think I've been having a debate with Karen, and this is a very interesting area, but I think we're covering that in question 2. So if we could maybe go on and just make sure we've covered all the terminology questions.
Sam, is your hand up around terminology? Okay, we'll hold it then until the next bit. Philip.
Okay, so yeah, so the first specific question we had was on the proposed terminology. So if we've had on the grant expense whether we need to introduce the concept of obligation into the actual expense, or whether it's the sort of the compliance obligation definition encompasses that, and then the grant expense is just the accounting of effectively that obligation being satisfied and an amount of consideration being given because it has been satisfied. We particularly wanted to know on binding grant arrangement, which we've discussed, that I think the phrase grant payment consideration, and whether consideration would be a term that is well understood in the MPO sector, because it is included in section 2, the concepts and pervasive principles, and we didn't pick up on it really at that point. But I think this is an area where it's really going to come out. So if consideration isn't a term that's well understood or used, if something else would be more appropriate. And then I think particularly this phrase extinguished for when a grant satisfaction rate has been basically fulfilled. if extinguished is seen as too legalistic or not understandable, if there's another term that people would consider more appropriate, I'll be very useful to know as well.
Ash, I think that was you searching for the hand button, so I'll let you go first.
So I was looking in at the paragraph 2.3, which we talk what is a grant expense. And it says a grant expense is an expense arising from a transaction in which a grant providing NPO provides assistance to a grant recipient, which may be an entity or individual, by transferring cash or service good. I thought we had just said that you can have an expense even if you haven't transferred the cash, because you've made the commitment. So you've got an expense which you need to account for and recognize. So you haven't transferred the cash. Maybe am I missing something?
Yeah, I think this should be obligation to. That's what I was saying.
Yes.
Yeah.
Well, the transaction ultimately will be the transfer of cash or a service good or other asset, and nothing will be directly received from the recipient. The timing of that actual transfer will generate other accounting entries, but the overall transaction will require the eventual transfer of cash or a service good or other asset to the grant recipient.
I understand that, but the question of being asked is what is a grant expense? So I can have a grant expense without transferring any cash, because if I've made a binding agreement or a contract or constructive obligation, I've got a grant expense without transferring any cash, and that could mean that I would have to account for a liability, and the recipient could recognize income even though no cash has been transferred.
But you have the liability to transfer the cash.
Yes, but that's not what it says. It says by transferring cash. So we're not transferring cash, but we can still have a grant expense. 2.3 as it's written. Seems to indicate that you can only have a grant expense when you've transferred cash or service goods. So when you've actually made the transfer, not when you have a liability to transfer, it's when you've actually transferred is what it's saying.
Yeah, I think this reflects the comment that Umu was making as well, and perhaps the word obligation is missing from that. We'll have that. We'll take a look at that.
So it's by an obligation to transfer cash or service good or other asset. Yes, I agree with that, but not by transferring cash.
Well, it could be both actually, because if the binding arrangement doesn't exist, our conceptual.
Oh, absolutely. I agree it could be both. But what I'm saying is that's not what it's saying. The definition as it's written in 2.3 says you can only have a grant expense when you've actually transferred cash.
Yeah. So just add maybe a transaction or obligation to transfer.
Yeah.
I mean, yeah. No, yeah. Yeah. Transaction or obligation of transferring.
Great. So I think that point's well made, and Karen's noted it that they're going to look at the drafting of that. So I'm going to move to Sam. Are you taking your hand down now, or Sam? Is that because the point's being made in other places? I'll go to Corinna next. Corinna, if you can come in now.
Sorry, I thought I would be waiting for someone else. Right. That's in response to question 2. If we are now on question 2, I do think that this terms variable consideration and extinguishment would be rather foreign and unusual for the sector. I haven't seen much of these terms around. So perhaps using something else would help. I can't think on the spot of anything else right now, so maybe other participants can help.
Does anybody else got any ideas for alternative terms of the list that are spelled out in question 2?
Financial support, funding, because consideration is a technical legal term for usually cash, isn't it? But it can be another means of exchange, value, perhaps something that might be better than consideration.
Thanks, Nigel. Anybody else got views on that or on the extinguish question?
Extinguish, you could put fulfill.
Yeah.
Sure.
Great. So is that enough?
Yeah,
Yeah.
those were the phrases we expected to be. I think it's going to said a little foreign to the sector. The issue we've had with things like variable consideration is actually what else can you call it? Because if we do have consideration as a term and it is variable, it's kind of defines itself. But if people do have examples from, say, maybe grant agreements where the amount that can be paid does vary depending on something, and there is a different term used in the sector, that'd be appreciated.
How about resources?
Variable resources, because I mean the thing is it's the transfer of resources, but the amount you need to transfer needs to be defined, and that's the consideration. I mean, it is normally cash, but
Yeah, sometimes they use this full financing mode or flexible financing mode. This is what I have seen, but that could be restricted to Eurozone grantors.
okay. Well, I think it's great for now. We'll try and come up with some more. It might be that we send literally definitions to this group to see if they're better over the course of the next month or so, and see if they resonate. That'd be useful. Excellent. So I think that's the terminology part done. The next bit is actually practical issues associated with the proposed conceptual approach. And even if we agree that conceptually this is a sound approach, what the practical difficulties would NPOs have in applying it? So we've got two sort of buckets here. The first is practical issues in relation to determining rights, obligations, and the amount of grant payment that needs to be made. And the four areas we looked at specifically were determining variable consideration, dealing with changes to the grant payment consideration that needs to be made, applying these principles to capital grants, and understanding the difference potentially between restrictions and performance-related rights and obligations. So if members have any comments.
I would like to comment, please. Yeah, I don't find again. Just to say again that as a practical issue, should add to those already identified the question of the provision for the cash. Even I heard, I think Pesh said that in some cases of binding arrangements, I mean, the donor will say that in case, okay, in case we don't have the resources, we won't pay the grant. There's a clause saying that, okay, in case of, but still, if this is not there, it should be really ensured that the liability is lying on actual resources.
Mm-hmm.
It happened to I had a case for like that there was an agreement to fund for 3 years. So it was expense out, I mean, as a grant expense, but in terms of cash flow, the funds were not there to ensure the liability. So that's a practical issue. I think we should, yeah.
I thought Pash nodding at that, and then I think it was Pash with his hand first, and then Nigel.
So, sorry, I'm just, are we actually talking about the point which we've got in, where is it now? Principal agent considerations.
So it's question 2. So it's all of that section, which is
Right.
section 3. Question 2, we raised some specifically, but if principal agent wasn't there, but if you do have a point on principal agent, we'd love to hear it as well.
Yeah, principal agent considerations. Increasingly, you were seeing consortia in the not-for-profit world. And the consortia comes in sometimes with several NPOs, but also sometimes comes in with a mix of private sector and NPOs. And then because of the differing rules about how maybe they want to choose to account for it, you get a sort of a mishmash and confusion. So I think we should try and somehow address that point. Because you can have a consortia, and the question is the lead entity, is the prime in the consortia, the principal, and others agent. So should agents only be accounting for their bits of it, or so the prime? So I think somewhere exploring that issue would be important.
Yeah, and that is included in the further developed core and application guidance, because we've agreed to integrate the principal agent issues into each individual section as they arise. Right. And that who is the lead in a consortia, who are the rights and obligations on, who is acting on behalf of who, and who actually has proper, say, skin in the game, is it's an area that's going to be covered. And I think it's an area where we are going to have to provide implementation guidance and examples. So if individuals have good examples of consortia, particularly if they are mixed, maybe public-private, MPO, public-private, that kind of thing, that'd be really useful.
Okay.
Nigel. Good, Pesh, carry on.
So on those questions, I think again, there are a number of practical issues, and perhaps maybe I mean I can send some examples of what I've seen in practice into yourselves. So I'm happy to sort of hold my counsel on that at the moment.
All right, we'll follow you up on your kind offer then, Pesh.
Yes.
So thank you, Nigel.
Paragraph 310, I was just going to suggest implementation guidance again. It talks about measuring the rate of progress by the grant recipient in constructing a capital asset, which implies in the commercial world, architects' reports, stages of development, laying the foundations, constructing the shell, fitting out, whatever. This one, though, is so loosely worded, it could be a matching principle, like you're comfortable with just matching to spend. So as I control the rate of progress, so I just match the spend. So we're moving towards more cash accounting for construction of capital assets. I didn't know whether you wanted to be as flexible as just running to cash, or you expect NPOs to agree stages of progress prior to the agreement being put in place in order to facilitate recognition. What was your intention?
And this is one of the reasons why I raised this point. I was interested in how realistic is it that actually an NPO giving a grant will monitor the actual construction, say, progress of an asset, and go in and say, okay, you're now at, say, 70% build, as opposed to actually you've spent 90% of the grant I've given you. Or actually, would they do any of that at all? And is it effectively, once the money's out the door, they're just recognizing the expense, and they aren't practically going to measure progress in any way?
I think it can be both ways. I've seen mostly them accounting for it once they spent it, but in some cases where the grant recipient, the grant maker has maybe less confidence in the grant recipient, you know, many grant makers have sort of tiers. So if it's a completely new grant recipient who they've never worked with before, and they're making a large capital grant, they may be wanting to ensure that they've that it's being built, the progress is happening. In other cases, they're happy to sort of, you know, they've got confidence. You've got the money, we know you're going to deliver, so go ahead, kind of thing. So it's there are two options, and again, I can give some examples where I've seen the different ones by different funders, and also the same funder having two different approaches according to how they view their confidence in the recipient.
So I mean, and this is actually, as we've been working through these practical issues, this is one of the areas where the accounting and the financial reporting could really drive improvements in financial management practice as a whole. So if there are if there are options which would drive better behavior in the sector, then we'd probably want to at least push those in either the application guidance or at least in the implementation examples.
Great. Well, I certainly investigated a very large construction fraud involving EU money in Kosovo on one time. So better practice around recognition would be good. Corinna, I think, was next.
Right, thank you. I have 2 points. First point is a complement to the capital assets discussion. What we frequently see in practice is that the funders actually want to retain, they have some retainer rights on those assets, and there is a residual involvement of the grantor. It could be in several forms. What I have personally seen and with different funders is either they request you to use it for their future grants only, which is quite odd. So it seems that it's counterproductive. You get the assets and you don't get them. Or they request to earmark it to a particular program that they were funding but no longer will fund in the future. Sometimes it needs to be transferred out somewhere, so it doesn't stay on the hands of the grantee. So how perhaps some illustrative guidance, implementation guidance would help in such instances. And the second point is actually on the changes in the variable, the consideration part from the funders and for the grantee as well, as at the end of the implementation period, usually there is an audit. It is followed by an audit, and there is usually either a last payment pending for the grant that is subject to the successful outcome of that audit, or at the end of the audit, this payment, the final payment, is reduced by the amount of an eligible cost, so funds needs to be reimbursed. So I don't know if this point is covered in further detail, but it is quite common amongst grantees that make liability and the provision for an eligible cost. Similarly for the grantor on the other side, who do not recognize this as an expense and are pending finalization of the audit work, and sometimes they have a right to recall the funder assessment up to 5 years until after the end of the grant period.
Great. Philip, shall I carry on taking points, or I think
while it's in my head, if I respond quickly, otherwise I tend to lose track. On the asset one, I mean, I think the guidance is going to be very specific that it will be an asset that the grant recipient then controls. So if there is this kind of residual interest that is still arising from the grant providing MPO who is dictating actually what can happen with the asset, effectively, I don't think that then the grant recipient does have control of that asset. So I think that's an area we'll definitely need to cover potentially in the application guidance to really hammer home that it has to result in the recipient having control. We were considering, say, if the grant recipient then, say, sells the asset, what does that mean if there was a term in the original grant that actually they then have to return it to the grantor? But I think the broader point of control is something we need to focus on. And then on the variable consideration, I think if a grant providing MPO, if it's common practice to say hold back 20% and they know of that 20% of the grant that normally 50% of that is ineligible, I think that's where the sort of provision part of the conceptual model will come in. And again, I think if we can provide illustrative examples of that and demonstrate that that is the correct accounting approach. So there is an expense recognized. You don't hold it off for, say, the 5 years, but you recognize that actually there may be changes made to that final grant. That again would be very useful, I think, for the examples. So if there are real world examples you have, again, as Pesh said, if you could send them through, that would be really useful.
Great. I think on where we got to now is it's Sam, then Dorothea, and then back round to Pesh. So Sam.
Thank you, Tim. I was thinking in terms of practical considerations, what this accounting treatment does is it puts some of the recognition criteria out of the granting MPO and into the grantee MPOs. It's their behavior and their actions and their fulfillment of obligations that enables the grantor to recognize the expense. And I think this might have some unintended consequences. So we talked about, more monitoring and driving good practice, and Tim used his example of fraud in Kosovo, and more monitoring might help that. More monitoring isn't necessarily always better practice. No. So as Pesh mentioned, you want the appropriate level of monitoring for the situation, and more monitoring isn't necessarily better. We don't want accounting requirements to drive practice about level of monitoring, right? It should be appropriate to the trust relationship and everything else. So I guess maybe that will come into binding arrangements and the nature of agreements and things like that. But very often the agreement might be standard format, and the monitoring arrangement is done as a basis of a risk assessment post-agreement. They're not necessarily baked into the formality of the contract. So I want to just wave a big flag that I don't want accounting practice to be driving monitoring practice, because that would be, I think, a very, very fundamental problem. I was thinking also about how, like in countries like India, where there's a requirement for an MPO to spend so much money. If that spending is also grant making, and yet the recognition of that is out of their hands. They might have made the grants, they don't have cash to make more grants, but they can't recognize the expense because the satisfactions haven't been fulfilled, if I'm using the right words. That could put those types of organizations in a very difficult position where they can't spend more because it's obligated or it's promised, and it's likely to be, and it's even in the hands of grantees that haven't yet spent it. The other practice and practical implication I'm nervous about, and this is one of the big criticisms of the MPO sector, is MPO spending because the donor's telling them to spend, and spending being driven by donor pressure rather than appropriateness in a context and in a certain situation. You see it all the time, end of the month, end of a grant period, we've got to get this out of the door, we've got to spend this. And then on one level, there's a positive element of driving implementation and activity and everything else. There's definitely a negative side of that, which is, just spending, because if I don't spend it, I'll have to give it back. And I'm also nervous about the accounting requirements that end up in INPAG actually impacting on that kind of practice. So I just wanted to raise those very practical flags.
Thank you, Sam. Dorothea.
Sure. No, I appreciate this very interesting discussion on 3.10, and that's where my comment is. And it's on the area where the grant recipient constructs the non-financial asset. And it's just offering suggestions. Perhaps that language could be strengthened by adding a couple of words as to the method for measuring the cost. It does say, as the asset's being built, measure of progress, kind of terms, all good terms like that. The IFRS for SMEs has a little more guidance as to reliability when the asset it can be reliably estimated, that it's that type of method that could be incorporated into measure of progress based on a reliable cost that is determined at the beginning. And then when there's not a reliable estimate, perhaps costs that are probable. Again, kind of just adding a few words with the intent that the method is not left to the recipient, that it's left to the grant maker NPO. And just offering that for consideration. Over.
Great, and back to you again, Pesh.
Well, actually, Philip, Sam, and Dorothea made most of the points I was wanting to make. I think the important point which Sam was making is that you don't want the accounting driving the behavior in an adverse way. As well as we recognize that the accounting can drive the behavior in a positive way, we don't want it to be driving it in the adverse way. And picking up on Philip's point about if you have to return the money. And again, it's the point that Dorothy was making about the probability. We very often I've seen the case where the grant recipient says, oh, we don't recognize this because we haven't recognized this asset because we don't really control it, in that if we had to sell it, like, for example, a local authority provides land to a school, if we have to, and then it says, but if you sold the land or if you closed down the school, you'd have to return the land to us. You're working on a sort of a going concern basis, you're working on a probability basis, and you would expect that normally you wouldn't be having to return the land, and therefore you would recognize the asset. If you thought you were now in a situation where you had to return the land or whatever else, then you would create a liability.
Mm-hmm.
Great, thank you all. And Philip, one more point from me. I think it might be worth taking some specific questions to the donor reference group around some of this, because I think in different philanthropic settings, the spend out requirements, and then there are other requirements, you know, so like in the US, for example, that if the grantee you're giving to has not got an equivalency determination, you can only recognize the expenditure in line with the expenditure of the grantee, if you, for example, not. So then it could get very complicated for the trustees of those organizations to actually manage. You know, they mainly think about approving the money, and then leave it to, if you like, the management of those organizations to manage everything else. You don't want there to be a massive reconciliation between what's in the audited financial statements and the way that these foundations actually operate. So I think.
And in terms of those foundations, is it the cash going out that's sort of like the key determinant?
Well, I think no. So I think we should kind of construct some questions to take it. I think there's not. I'm afraid we might find that the practice is quite different in different nations and so on. So it'd be worthy of having quite a rich discussion when we've got a number of those different foundations in the room.
Yeah, because this is the big interplay between the sort of cash and accruals, and as was raised about, okay, you might recognize the liability or the expense, but do you actually have the cash when the payment is actually going to become due to fulfill what you've said you are going to do? So yeah, that's why it's interesting. That's why I like this one. I'm very conscious that I've taken up a huge chunk of the meeting. We did have a question, the remaining question on disclosures and guidance, and any additional guidance to get through. Tim, do you want to cover that, or do we deal with that through sort of correspondence?
Let me just look at the agenda. Give me a sec. I think Karen and I predicted that this might happen. So let's cover it, because I think bizarrely, because I think we're asking less questions on revenue, I think we're going to spend less time on the revenue paper. So yeah, let's cover it here for the.
Okay, so the disclosures that we have noted, I think our key is what practical issues would MPOs have in actually getting those disclosure requirements? And I think more importantly, is this what the users of the general purpose finance reports would want to see in the MPO context? Because these disclosures, other than the principal agent, are fairly driven by the sort of IPSAS approach to what disclosure required. But is there something missing here that in the MPO context we'd really expect users to want and that MPOs should be providing?
Sorry, Philip. Are you going to question 5 essentially?
That was question 5, yeah. So
yeah, and so do we feel we've adequately addressed questions 3 and 4 in the paper, or?
I think the payments of grants we've done. The grant prepayment asset, actually, we didn't cover the grant prepayment asset. You're right.
Yeah, so Karen, I think we've got, it's worth taking the time, isn't it? Because these are quite
I think in terms
issues,
of,
or what you.
I think in terms of the time we've got, we're probably better to go to the last questions, because that they're sort of quite technical areas, and for those who've got any comments on it, very happy to take those outside of the meeting, so that we've got a little bit of time to talk about the revenue stuff.
So we're gonna skip over question 3 and 4. So if you've got any remaining points to make on those, please do so by email. And we're looking now at question 5 around disclosure. Any comment? Pesh, is that a live hand or an old hand?
I suspect it's
Nigel, let's go to Nigel. Thank you.
Yes, my only remark is really this needs to link closely to the narrative reporting. It's difficult to see this in isolation, because one of the things that the UK has found from consistent polling of general users, mainly the general public in fairness, is they want to know what difference the funding has made. So the issue here around the grant liabilities is what difference is the funder seeking to make through making these grants. And that certainly the UK Charities Silk tried to do that by providing some information around the institutional grants rather than grants to individuals due to privacy and other considerations, to give a flavour as to what organisations were receiving funding and from me, and therefore how I was furthering my purposes. I think that link, whether you draw that out in narrative reporting or cross-reference here, is perhaps the one takeaway for me, subject to comment from those working in the sector, of course.
Yeah, so in the sort of fuller worked up core guidance, it is the basically the purpose of these arrangements leading to expenses is sort of front and center, and why are these things being done in the first place. So if we can then specifically link that through to section 35, the narrative, yes, 35 narrative reporting, and then I think this is as INPAG's developing, we're going to see this more and more things that we've actually done and are semi-parked, we're going to have to reopen and relink things back together. But yeah, why you're doing these things is very much front and center of the disclosures. There's then this more technical, okay, so specifically what do you have to put in?
Great, Corinna.
Yes, sorry. Yeah, I would like to build on the top of narrative reporting. Many of these NPOs, if not all, sent some sort of MD&A, a short MD&A intro to their financial statements. And often in practice, what we see is that in the MD&A, they're either repeating what is in the general purpose financial statements, but translated into plain English, or some additional information. So the disclosure should remain fairly simple for also other users and key stakeholders to understand, so that it is cross-referenced and avoiding duplication, and additionally avoiding disaggregation of data.
Great. So I'm going to take the lull to mean that we can move on. Any final remarks, Philip, about this paper before we move to revenue?
Just to thank everyone, because I know it wasn't the easiest read, it wasn't the easiest thing to write as well. And we're trying to get the balance right between getting the technical points across and it just being too technically focused. If anyone does have any examples as we start to develop this over January and February, if they could send those through, even if it's links to websites, if it's links to reports, if it's even personal stories and case studies, because we really need this to come alive. because this is an area that we really need a lot of sector buy-in, I think, for. And if there are more of those sort of unintended consequences that we need to consider, where we might actually have to be a bit less, potentially a bit less purist on the accounting to ensure that we can be delivering something that the sector would actually implement. Those will be very useful as well.
Sam, you've got your hand up, is that?
Yeah, just a very brief one on the disclosure of in 4.2, where you said about analysing grant expenses according to whatever we end up with the grant expenditure classifications in part 3. Just a sort of pre-comment on that. I think that would very much depend on the MPO. So if the MPO is a grant maker and that's what they do, then you'd want to have some kind of, you know, analysis of, is this going for different activities?
Yeah.
But if grant making is a small part of what they do and mostly implementing, then you'd want to see, you know, I think there's a lot of interest in seeing how much is as grant making as opposed to as direct implementation. And you wouldn't necessarily then want to split that out. So just I guess a bit of a pause or hold that thought for later down the line.
Great, so well done, Philip, and very good discussion, all of you, and lots of rich input for the drafting team there. So if we now turn to revenue, I think it's going to be Karen and Paul who's going to introduce this.
I'm going to let Paul kick off. Thank you.
Thanks, Karen. Good morning, everybody. So the revenue, we're not as far advanced as the grant expenses paper yet. We're still looking at some of the key decisions to be made, and TAG is going to be discussing those in January. In terms of feedback from respondents, when we consulted on the non-exchange revenue, and there was a general support for recognising revenue when for those grants that were given with conditions or where requirements had to be satisfied. There was that sort of a general agreement for recognising revenue when those requirements, those terms were satisfied, fulfilled, which is in line broadly with the way that the accounting standards are developing. In terms of developments on the accounting standards, which is sort of playing into the decisions we're going to be looking at, we've got changes proposed for both IFRS for SMEs and for IPSAS. So for IFRS for SMEs, while there's limited change to the non-exchange, the sort of the government grant section in IFRS for SMEs, the exchange revenue, the contractual revenue, is being, in the latest exposure draft, that is being brought in line with IFRS 15, with all the complications that IFRS 15 brings. And it is a long section. It's about 120 something paragraphs long, which is second only to the concepts and principles section in IFRS for SMEs now. So it is bringing in a lot of complications. And the IPSASB, when we looked at that, developing the consultation paper, there were two revenue standards, one with binding arrangements, one without binding arrangements. Same sort of terminology issues here as we've got with grant expenses, so we'll have to look at those in parallel. Since then, the IPSASB has been revising its standard. It is now proposing a single standard that deals with both the exchange revenue and the non-exchange revenue together, because the principles of recognition for cases where the recipient is required to do something, whether that's complying with commercial terms or complying with grant conditions, are actually the same. You recognise the revenue once you've actually done what you promised to do. So the IPSASB is working, or just about finished working, on a single standard that will bring both of those together. And the distinction there, similar to what Phil's been talking about in grant expenses, is between revenue where there's a binding arrangement and revenue where there isn't. And the first question we're asking the PAG and also taking to the TAG is, which approach should we adopt? Should we be looking to have two separate sections in INPAG, which would be retaining the IFRS for SMEs section on contractual revenue, so IFRS 15 section, and then developing the non-exchange revenue section? Or should we be looking to be moving towards the IPSASB's approach, where we have a single section that brings both together? That's probably going to be simpler to understand, but or simpler for people to follow, because there is just that single section. Excuse me. So all the guidance is in one place. They don't have to, NPOs won't need to distinguish between exchange and non-exchange revenue when they're looking for where to go. And overall, guidance is likely to be shorter. But for those NPOs that only have grant or donations, then the guidance may look to be more technical. And it will be additional work, as we're then going to be revising both sections 23 and 24 of IFRS for SMEs. For the two-section approach, it's kind of the opposite. Simpler for those NPOs that only have grants or donations. Less work because we don't have to amend section 23, but likely to be quite a bit of duplication. More complex for those entities, those NPOs that do have both exchange and non-exchange revenue, that they'll have to decide whether that particular transaction is exchange or non-exchange, and then go to the appropriate section. So I think the thinking, what we're looking for from the PAG is what approach do they think NPOs are likely to prefer?
Thank you very much, Paul. I'm going to invite, I know Nigel's got his hand up. I'm going to invite Sam first, just to share Caroline Cordery's comments that were prepared in advance, then I'll come to you, Nigel.
Great. So Karen said that she leans towards one section. If we do go for two, then a really good flow chart would need to be designed. She says that there are occasions when non-for-profits have both exchange and non-exchange revenue in the same transaction. And while there might be a need to still split treatments, it may be easier to guide someone through that in one section. So she's definitely leaning on the one section approach. Thanks.
Thank you, Nigel.
Thanks. I think from the UK perspective, gifts in kind has been the major area of problem in valuing the totality of revenue, which is why the UK charity sort was a separate section, because gifts in kind, not mentioned in this document, prove significant issues around measurement. So just a couple of examples by way of illustration. Bookkeeping services gifted to an NPO, provided by a homemaker, traditionally zero value because there's no market for homemaking. So that's a general volunteer, you don't price general volunteers. But if that service is provided by an accounting technician, would you value it at the rate of an accounting technician? But then if a partner provides that rate, do you do it the rate that is foregone from the firm, sacrificing the partner's time? So you have three different values for one transaction. Looking at goods, gifted vehicles to an NPO to provide services and facilities. If you'd had to finance it, it would use second-hand vehicles because they're cheaper and that's what we can afford. But it's been donated a fleet of Mercedes-Benz. Do you do it based on what they would have bought had they had the money, which might have been a Ford Transit? Do you go on Mercedes-Benz retail value, i.e. the customer would have paid for a unit? Do you go at trade price for the Mercedes-Benz fleet on the grounds that would be the minimum price that they would get rid of those vehicles to trade? Or do you go the basis of the average price that they've been selling to customers who've generally bought, because they often offer a discount, 5 prices? So I think whether it's one section or you choose to do two sections, gifts in kind are a significant issue and deserve some reflection. I think a separate section might help, but I'll be guided by those working in the sector. Thanks.
Thanks, Nigel. Points very well made. I think we'll go to Umu next and then you, Pesh. So Umu.
I can't hear, sorry.
Sorry,
Is it to me?
Yes.
I have the floor? Sorry.
Yeah, you have the floor, Umu. Can you hear?
Okay, thank you. Thank you. Yeah, I can hear now. Sorry, I'm not in my country. I'm abroad. I'm on a mission. And I think internet is not very good here. So just for revenue, for the distinction between exchange and non-exchange, and definitely I think it's the occasion to say that this term was quite confusing even for us here. And really, it's a proposal to take like self-generated revenue and grants and donations, these two sections. So that would be, I think, better than exchange revenue and non-exchange. So really, and the we appreciated also the 5 steps to recognize service in kind donations and services. Yeah, I think that's all I had to do say. But really, it would be, maybe self-generated is, we can find another denomination, but grants and donation and whatever is not grants and donation would be the other section, would be the other kind. And it's important to have the separation, because as we discussed during our previous sessions, when it comes to self-generation of revenues, then we come into tax issues, and it's good to precise so that it doesn't have a great importance compared to grants and donation, which would be the principle. Thank you.
Great. Ash.
Thanks, Tim. Picking up on Nigel's point, I think this point is important, not just for revenue recognition, but it's also important for when you look at things like impairment, etc. It's the whole question of value in use. And I think that's where the nonprofit sector is different. And I would certainly not be looking to, I struggled with this concept, which we had to put into the SORP because we couldn't think of anything else, which you would otherwise have had to pay for. So, I have often given the example where I sit in an audit committee, and therefore you might think that you need to value my time because you'd have to otherwise pay for it. But there's maybe another lady on the audit committee who's actually more useful than me, but because she's not a practicing professional, you wouldn't be paying for her time, so therefore you wouldn't value it. I found that really quite difficult, and therefore I took the approach that we wouldn't value my time or her time or anyone's time on that audit committee. We would just be treated as volunteers. But the value in use point, I think, is really quite important, is saying, what would the organization have paid for the asset if it had to? So would it have, first of all, would it have in fact bought it if it wasn't being given it? And if it had, what would it have paid to it? And that applies whether it's an office space, whether it's the Mercedes-Benz or whatever else. And I think that concept needs to be explained a lot better in the not-for-profit context, both revenue recognition, impairment, etc. I'm still missing this thing. I don't know whether I missed it in the paper I've read, between making the clear distinction between a restriction and a condition. And do you recognize the revenue when you have a restriction, which is not a condition, i.e. it's just telling you that it's still your money, but you have to spend it in a particular way. And maybe I've missed it, but I couldn't see that in the paper.
No, I missed it as well, Pesh. The parallel paragraph to paragraph 3.8 in Grant's paper is not there. So in theory, the way I read it is that I can match a restriction is a binding agreement, and therefore I just match to spend. That's cash accounting.
Yeah. So I think Karen's going to come in on that. And yeah.
So please don't read anything into that. This paper does not cover any of that, like it doesn't cover any of the stuff around gifts in kinds and service in kind. It wasn't intended to. So this paper was really focused on the organizing the content of this, and what is the best way of doing it. We haven't gone to actually what's going to be in it as yet. That is still to come. So please don't read into the fact that there's nothing there, that we don't have any intent to say something. I think from my perspective, it's been a really useful discussion around I think the sort of the gifts and services in kind. I think with a lot of the thinking that we've done so far have been more about the kind of the cash-based transactions that can be exchange or non-exchange, and thinking about how we would organize that. And I think we probably hadn't turned to what we would do with the gifts in kind and services in kind. But I can see an argument for separating revenue effectively between cash-based, not, I have to be careful about the word cash-based, but revenue that comes in the form of cash versus gifts in kind and services in kind, and actually that may be a more useful way of thinking about it, and is certainly food for thought. I don't know whether Paul has got thoughts on that too.
Yeah, just before we go to Paul, just a second, Marcel, did you want to come in? I saw your hand go up at various points.
Thank you very much. Thank you very much. We are a practitioner advisory group. That means, the way of thinking, not from the accountants, are very important. This is the 21st century. So the fact is transparency and or something like that. I think a cash base is very important. In-kind donation is always some discussion, the measurement or some other points, and especially any kinds of the items. For example, something with truly related to God. It's in the world there are so many gods, So this God. It's any item. This God is a $100 measurement. This God is a $200 measurement. Such kind of measurement is impossible. So that the language is not only money. This is the 21st century. We are looking forward to the accountability, transparency. So let's say that. So it's easy to take a picture and get on the website. Such kind of the disclosure would be maybe in the future. I believe that the such in-kind donations discussion is sometimes a little bit, too conceptual. Let's say the comparativity. You are important. You put in much more importance of the comparativity. But I think that less misuse is much more important for the NPOs. They are very honest and they are very active, and they so that they have to any kind of the activity related to honesty. So it's easier way for practitioners is much more important. I'm very sorry, a little bit curious opinion, but I think practitioner advisory groups' importance is very much a different opinion. It's okay.
Thanks, Marcel. I think obviously when gifts in kind comes back at some point later, it sounds like it's going to be a very rich discussion around all of that. So I think that's Karen's and the team will take that away about how we approach that when it comes. But I think you've probably got enough what you needed, Karen, on terms of just the overall structure of this. You've got a range of comments to sift through. Is there anything else you wanted, Paul?
No, I think we've got a range of comments about how we structure it, one or two sections. I think a lot of the terminology discussion we were raising has probably been covered already in grant expenses. And yeah, and we had the feedback that, you know, the distinction between exchange and non-exchange revenue was difficult. So we'll take that away and see what we think. Just coming back to the grants in or gifts in kind. We haven't covered it in detail here, but paragraph 2.4 does sort of mention the feedback that we got from respondents on those. We were suggesting a range of possible exemptions from the normal recognition provisions. So, for example, only recognising revenue from items donated for resale at the point that you actually do the resale. So recognising and measuring the amounts based on what you sell them for, rather than trying to value them beforehand. And those sort of things were, there was a range of different views on different types of transactions, and that's sort of set out in paragraph 2.4. We'll take that into account when we're developing the revenue sections. We'll look at those when we're looking at the gifts in kind, and we will address those specifically.
Great, thanks, Paul. So we are close to a time. So we were, as predicted, didn't get to the other paper on outreach. So we're very much just looking for any advice you would offer about how we're doing that outreach. So encourage you to read the paper. If you've got comments in relation to those questions, please email us, especially Sam, who's managing all of that outreach. But it's going to be very exciting, not only to be hearing from stakeholders, but to actually be meeting stakeholders for the first time in quite a while in person in Latin America. So that will be we'll learn from that as well. And we hope to do some in-person consultation at subsequent exposure drafts tranches, so 2 and 3. So it's obviously really, really important to get stakeholders' views on our proposals. Thanks to all of you today. It's been invaluable. I know the drafting team massively, values your comments, which come, as Massa has said, from a different perspective than the comments that we tend to get from the tag, and it really is invaluable. So thank you for your participation today. Have a good break if one is coming up for you, and we'll be seeing you in 2023.
Yeah.
Excellent.
Have a good break, everybody. Thanks very much for your input.
Thanks.
Bye.
Thank you. Have a good break. Bye.
Bye. Bye.
Happy New Year.
Happy New Year. Bye.
Bye.